Hey, Boris Mushev here, and welcome to Best Retirement Tax Strategies for 2023. And today, we're specifically going to talk about retirement strategies when you are a solo owner, meaning you have no employees. And then we're going to talk about when you do have employees, right? Which traps to avoid with the IRS and how to best maximize your tax deduction. All right. Now, if you do have employees and you're watching this video and you say, you know what? This section is not relevant to me, you're wrong, because you really have to understand the retirement strategies for a solo owner in order for you to understand how to maximize your deductions when you do have employees. So definitely stick around because there is a lot I'm going to cover, and I'm going to cover it in a language that you understand and make it simple for you. All right, awesome. Let's kind of get started with this, okay? So when you do not have employees, right, there's two retirement accounts that you can utilize in your business to maximize your deduction. One of them is SEP IRA, and another one is a solo 401k. Most of you are probably familiar with what is a 401k. Solo basically means you are a solo owner, solopreneur, right? You have no employees. And there's big differences between them both, right? Solo 401k allows you to contribute a lot more than a SEP IRA. So let's kind of dive into this, right? When you are running your business as a sole proprietor or single member LLC filing a Schedule C, then your maximum contribution to a SEP IRA is either 20 or 25%, right, of your net profits. What do I mean by that? If you are a solo owner and you make $100,000, you can put away $20,000. When I say solo owner, you're self-employed and you do not have a corporation. If you're taking out a salary, then you can put away 25% of your salary into the retirement contribution. Now remember, this is a business tax deduction. That means your business gets a deduction for you, right? Now the reason I emphasize that is, unlike other retirement accounts, there's nothing that has to come out from your paycheck. You just pay yourself a paycheck, or if you're a sole owner, keep everything as is. You can make this contribution. The best part about SEP IRA, when you're ending off the year and you don't have enough cash flow to put money into SEP IRA, well, guess what? The deadline for you to do it is until you file your business taxes or your personal taxes, right? So if this is an S corporation, for example, and you pay yourself $100,000, you can put away 25%. You don't have to put this 25% before December 31st. You can do it until you file your tax return, which is March of next year, unless you have extensions, right? So if you don't have enough cash flow right now, well, guess what? This gives you such flexibility. The best part about it is that it's simple to set up and it's cheap to set up. There is no maintenance of it, right? If you have a spouse in your business, no worries. Your spouse can follow the same rules as you do, but the spouse has to be on a W-2 for a SEP IRA. Do not set up SEP IRA if you have employees. A lot of business owners make this mistake. They say, you know what, well, I need retirement for myself, and I heard SEP IRA is good, and if that means I have to put away for my employees, I will. Because the rules of the SEP IRA say that if you're going to put away 25% of your paycheck for the retirement account, well, guess what? You have to do exact same thing for your employees. I had several clients that said, yeah, I have SEP and I have employees, and my employee, let's say, makes $100,000, I put away $25,000. So why do you do that? Say, because, well, I also want to put away $25,000 for myself. And I'm like, but it's costing you $25,000 per employee. Like, yes. And they're like, well, is there a better option? Yes, there is a better option. And we're going to discuss that in owner with employees. But understand that SEP IRA, you should not have a SEP IRA or a solo 401k when you have employees. You should have simple or 401k. We're going to talk about that. Okay? Now, like I said, it's simple and cheap. The maximum contribution that you can put away, once you calculate your 20 or 25%, the maximum contribution that you can put away is $66,000. And if you're over the age of 50, it's $73,500, because there's something that's called a catch-up contribution, meaning, say, you're catching up for all your young years, right? Now, jumping to a solo 401k, what's the difference between SEP IRA and a solo 401k It's pretty much the same thing when it comes to business contribution, right? The business can put away also 20% or 25%, right? Depending on what business entity structure you are. That is exact same thing, right? There's an addition to it. You as an individual, right, can also put away on top of the business with a solo 401k $22,500. So if you are an S corporation and you open a solo 401k, not only will your business put away 25% of your salary, that's a business benefit, fringe benefit, but you as an individual can put away $22,500 from your paycheck. So for example, if your paycheck is $100,000 a year, well, guess what? You will only pay taxes on $78,500. $100,000 minus $22,500, exactly, right? That means from your paycheck plus this. So definitely gives you a bigger contribution than SEP IRA. If you're over the age of 50, well, guess what? You can put away $30,000. Now, people ask me, Boris, should I open SEP IRA or solo 401k? I mean, both are simple and cheap to set up. There's not too much administrative cost, and it's very, very simple. The difference between both, I would say, and this, I would make this recommendation to everybody, do you have enough cash flow to put away not only 25% as a business, but also $22,500? Like, yes, Boris, I want to maximize as much as I can. We go with solo 401k. If somebody says, no, Boris, I don't have that much cash flow, but I still want to be able to put away something, then I go, let's just keep it SEP IRA. We don't need to jump over here until we're ready. We don't need to create extra complications for ourselves, because solo 401k, right, it's as simple as SEP IRA, but again, there is W-2 involved, and there is some withholdings, contributions, deductions from the paycheck. We don't want to do that right now. Let's just keep it very simple and clean. You're like, Boris, I want to maximize it. I want to do this, and that. Want to get to, 66,000 without the whole percentage limitation from my own paycheck. We do a solo 401k option for the clients, and we explain it to them. And it also has to be part of the W-2 paycheck if you receive paycheck. But when you do not have employees, these two options are the best. Of course, there are other retirement accounts such as traditional and Roth IRA. We're not talking about those because those are just individuals. We're talking about when you have a business, okay? Now, moving over to when you do have employees, there's two types of retirement accounts that you can set up when you have employees, right? Because remember, when you're setting up retirement accounts, you're probably doing it for two reasons. Reason number one is use it as a tax strategy and maximize your tax savings. Reason number two is employee retention, right? You want to make employees happy, they would appreciate you more, they would show up for work more, whatever that reason is, right? But you gotta know the differences between these two to see what is the purpose of why you're setting it up. And we're gonna talk about that, right? Let's start with a simple IRA. Now, simple IRA, the language speaks for itself, right? It's simple to set up, it's simple and cheap, okay? Now, the business for the simple IRA matches 3% of your salary, of your employee's salary, including yourself. So everybody that makes a salary, the business says, you know what, we're gonna do something really, really nice for you. And the way that simple IRAs are set up, we're gonna put away 3% match for you, okay? 3% match. So if you make $40,000, we'll give you $1,200. If you make $50,000, we'll give you $1,500. Done deal. That is a company benefit that company pays, and a company gets a deduction for it. On top of that, any individual, whether you are an employee of your business or you've got employees, right? They can put away from their paycheck, has nothing to do with the company. From their paycheck, they can put away $15,500 from their paycheck, or $19,000 if they're the age 50 or older. That means if your employee, or even yourself, let's take you for an example. This is your business, you're an employee of your business, you can put away $15,500 from your paycheck, right, into a simple IRA. That has nothing to do with the business. So if employee Joe works for you and says, you know what, I also want to put away $15,500, no problem, they can. This is their paycheck. You as a business owner are only obligated to match them 3%. That's it. Okay, that's it. So this $15,500 or $19,000, it's a per paycheck contribution. That means when they do get paid from the company, they get money taken out from or you pay them, right? You have to have money taken out from their paycheck to contribute to a simple IRA. Okay, very, very simple, but this is the maximum contribution right here from the individual's paycheck. $15,500 and $19,000 if they're at the age of 50 or older. You're like, okay, Boris, this is great, but what is the difference than 401k, right? I always hear the term 401k, right? And a lot of people do. They say, Boris, 401k compared to simple IRA. So let's jump to 401k. Now, 401k is a simple IRA, but on steroids and has some extra options that you can use. Now, just like with the simple IRA, with the 401k, you also do a 3% match or 4%, right? That depending on the plan. Sometimes you can have 10%, 5%, depending how you set up. Because with a simple IRA, you're only limited to 3%. With a 401k, it can be 3% or more, all right? So if Joe Schmo makes $100,000, guess what? They can put away you 3% and you can match 3%. But individuals now have a higher limit of contribution from their paycheck compared to simple IRA. See, with the simple IRA, you only have to put away $15,500 from your paycheck. But what if you want to do more? Then guess what? The limit over here is $22,500, okay? The limit here is $22,500. And if you're over the age of 50, that is $30,000. So that means if you are getting paycheck from your business, you can put away $22,500 from your paycheck, okay, into a 401k account. If you are over the age of 50, you can put away $30,000. So if you're making $100,000, guess what? You can put away $30,000 into a 401k, which is much bigger than $19,000, right? And your company can just match you 3%. So if Joe Schmo comes, hey, business owner, I want to put away as much as you do, $30,000, I'm over the age of 50, I gotta get my deduction up. Well, guess what? You as a business owner do not have any obligation to match him at 30%, at $30,000. Dude, I can only do 3%. Those are the rules in a plan document, and that's exactly what we're gonna do now. Very, 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 very important. Please, when you are setting up your 401k, make sure that the language of your 401k says safe harbor, okay? Safe harbor basically puts a 3 or 4% limit of how much you are obligated for your employees. Some plans don't have safe harbor. A checkbox was not checked off and the employer, the business owner, is screwed. I've seen those situations, okay? Now, the great thing about 401k is that it has something that's called profit sharing option. For example, let's say your company has a 3% match and you already maxed out your $30,000 from your pocket because you're over the age of 50. You're like, but I want to do a maximum contribution. How much more can I contribute to a 401k? The answer is actually, you can contribute, right, up to $66,000 or $73,500 if you're over the age of 50. But you're like, Boris, I'm being stopped at $30,000 and at 3% of my salary. How do we do that? So every 401k has built in it what's called profit sharing option. Now, of course, it has to be in your plan document. Profit sharing option basically says, you know what? Why don't we run a payroll census and see how much more you as an individual, as an employee of the company based on your age, right, can contribute based on your age and some other factors based on your salary and so forth, can contribute to profit sharing to hit these maximums. In some cases, these profit sharing options might hurt you. That's why it's optional. When you have a lot of employees, when you start doing profit sharing, it doesn't mean that they're being shared profits of the company. It's just that's how the plan is called. So the third party company that does all the retirement for you, they will run those numbers for you and they will say, you know what, you've got 10 employees, and if you do profit sharing option, this is how much you have to contribute for them. Makes sense, doesn't make sense. In some cases it makes sense when you got few employees, and in some cases does not make sense when you have a lot of employees. Now, I've had clients on both sides, right? I have clients who have exercised the profit sharing option, worked beautifully for them, And some clients just did not make sense. I actually had one client send me a proposal from a third-party company that does his retirement, and they ran the numbers. It does not make sense. It's for him to do profit sharing for whatever reasons, right? So you want to make sure that your tax advisor, you always talk to a tax advisor about this. Now, the thing with the 401k is generally, like I said, there's a third-party administrator, right? TPA. A TPA is basically somebody who files taxes but for 401k. Accountants usually don't do this. I haven't met an accountant that does this. This is a separate specialty, and they generally charge about $1,500. So while this is simple and cheap, this is simple and cheap, this is simple and cheap, this right here you would have to probably end up paying about $1,500 on your retirement option. Now, if you say, Boris, what is the difference if I do simple IRA and 401k? That depends. Some people just don't believe in retirement accounts. Like, I don't want to do retirement accounts, but my employees want it. If that's the case, go with something with simple and cheap. You probably will not put away more than 3% for your employees anyways. So just keep it simple and cheap. That's it. And if you want to put away some money into your retirement, well, guess what? You got a $16,000 or $15,000 limit. Some people want to use for a retirement account as a tax strategy and as a nest egg to build up their retirement. Then you want to go with the 401k option because it allows you a lot more contribution. That is when you have employees, right? When you don't have employees, again, ladies and gentlemen, solo 401k, if you want to build up your retirement nest egg, want to put away as much as possible, that will be solo 401k, right? When you do have employees, max out your retirement, that would be a 401k, okay? Now, a lot is involved when implementing these tax strategies, right? This is not just a matter of opening up a retirement account with a financial advisor. A lot has to go on a back end to make sure that the deduction is captured, your W-2 is adjusted properly, and it's properly captured on your tax return. A lot of times, right now we're approaching year end, a lot of times I've seen, and I spoke to a client yesterday, says, yep, I don't know what my payroll company is doing, I don't know what my retirement company is doing. These two people are not talking, and you don't have a tax advisor in the middle, you are screwed, okay? So, setting this up is nice. What's important is implementing all of this on your taxes, because at the end of the day, this gives you tremendous tax savings, helps you build up your retirement nest egg, and sets you up for success. I hope you liked it, and subscribe to my channel, right? Every Tuesday I release a tax strategy video, and we try to keep you informed as much as possible. My name is Boris Moshev, I'm a CPA. If you like the video, please like the video and subscribe. And till the next time.